What's interesting is the banking sector had its crisis back in 2007 and 2008. And so as a consequence, actually has spent the last 10, 12 years improving its business model and improving its resilience in economic downturns. Just an example, the amount of capital that banks held going into the crisis was at all-time highs. And over the course of 2020 and 21, that's only increased further, making banks even more resilient. And so banks were strong going into the crisis. They're emerging from the crisis even stronger. And now as we enter an economy that is starting to open up, as we say goodbye to the influence of COVID and lockdowns, and as the economy allows to grow, this is an environment where not only are the fundamentals very strong, but the economic growth and higher rates that we're likely to see on the back of that will be the tailwind to improve bank profitability and improve fundamentals further. So not only are the fundamentals and the bottom-up story of banks incredibly resilient, but now we have the tailwind of an improving macro environment, in particular in Europe, where we've had negative interest rates for the past few years. Now we're starting to get to a point where that might be moving closer to even zero. Now for European banks, that would be a huge improvement in its profitability environment, and that would go even further to improving the fundamentals of the banking sector. So for us, the best value is going to come from the European banking sector. Here, you saw a huge amount of provisions being taken over the course of 2020, and a large number of these provisions still need to be released. So even if you don't believe in the higher interest rates within Europe and steeper yield curves, just the unwinding of those provisions that have been taken should provide a tailwind to profitability. And when we look at European Bank AT1, this is the area where the most spread is offered and where you're likely to get the best risk-adjusted returns, in our opinion, because you're trading 85 to 100 back of high-yield double Bs, for example, and as much as 250 basis points back of lower tier 2, which to us makes no sense and should compress over time. The banks are on a journey, and I think you can see how in the future they will continue to be the conduit for policies and for regulatory change within the sector. And just like capital has improved over the last 10 years, which is regulatory driven, you can see how the sustainable policies that are driven by the regulator will be facilitated into the real economy via the banks. And if we think there's 4.7 trillion of spending that needs to be done over the next 10 years to meet the 2030 targets, 3.5 of that will come through the private sector, and the banks will play a huge part in that.